Thanks to a range of trade agreements between the US and its partners, we had a relatively calm summer on the tariff front. But it's questionable if this really stays, as we have already some issues, particularly the negotiations with China continuing. Nevertheless, on the geopolitical front, things remain very unsettled. Despite some initiatives, there is no progress in ending the war in the Ukraine. And at the same time, we have seen at the meeting of the Shanghai Cooperation Organization that the Chinese President Xi is trying to form new alliances in order to strengthen his global position in having a global role of power. So geopolitics remains very up to date, but markets do not really care. Markets did care, at least temporarily, about the increase in US debt. We have seen this beginning of September having some impact on the long end of the US yield curve, which was spreading out on a global level. But with very weak data from the US labor market, we have seen a change in expectations regarding the Fed. And actually, the Fed delivered with a 25 basis point rate cut in September. Now, going forward, the market, we as well, expect substantial cuts in the Fed funds rate until the end of next year. But these cuts are not done on an independent way, at least in our view. We think that an independent central bank would have the pressure coming from the tariffs on the US side into the equation and be very reluctant in going ahead with substantial rate cuts. In that respect, the speed on the rate cutting way is likely to come after Jay Powell has left its job as chairman of the Fed. The market so far was ignoring these attacks on the independence of the Fed. But in our view, this is likely to change, and they will see that there is some worth in the independence. So we think that with increasing inflationary pressure over the course of next year, there will be a steepening in the US yield curve, and yields on the long end will be higher as they are now. Coming back to Europe, we have seen here pressure on the debt markets as well. There is no ECB that will be undermined in its independence to come to the rescue. But there might be other ways where particularly France, which has come into the focus of market participants, might find a way out. And that might be more help from its friends. We think that there will be more initiatives from France coming up to get support from the west of Europe. Supported by countries like Spain and Italy, but also the EU Commission, we think that there would be a new wave of mutualization coming through, probably in combination with some closing of the guards on the defense policy. In this respect, it is very important that Germany, if they give in such a deal, will go ahead with reforms. That has to make sure that it's not just money is put on the table, but structural reforms that will allow Europe to go ahead on a way to get higher potential growth. Now, a last look at the markets. We have seen very overstretched valuations, particularly on the equity market recently. This could go along for a while, but the risk of a drawback is increasing, and it might come from a cooling down of the hype of AI.